For the first time since 2020, the Federal Reserve is finally expecting to start their rate cutting campaign. And this is expected to happen as soon as September 17th, which is the next Federal Reserve interest rate meeting. And the market now expects a 4% chance of a jumbo 50 basis point rate cut. And although we did see a few rate cuts at the end of 2024, this time is completely different because the market now expects rates to fall all the way from 4.2% right now to under 2.8% by the end of 2026. And because of this major macroeconomic shift, here are the top two stocks I'm buying for 2025. And the very first stock on this list is SoFi Technologies, ticker symbol SOFI. And we've been buying SoFi ever since $11 a share, but despite that, I still think SoFi is providing great value today at $25 a share. But before I talk about why I think SoFi is a good stock to buy, let's first talk about why I think lower rates are good for a company like SoFi. So even though SoFi will have to start charging less for the loans they sell, they also have to start paying customers less for the deposits that they hold. And this allows them to increase the margin spread between the loan to deposit ratio. That's the first reason. And the second reason, which I think is the more important reason, is because at this point, a record amount of car loans, home loans, student loans, and personal loans have been waiting for years for rates to drop so they can finally refinance their debt. And so this will massively increase SoFi's revenue from loan re-origination. And now let's quickly talk about SoFi's business model. So if you're not familiar, SoFi essentially is a one-stop shop for checking accounts, savings accounts, brokerage accounts, credit cards, personal loans, home loans, student loans, car loans. So basically it's a one-stop shop and it basically acts as a bank. And you might look at this picture and you might say, oh, SoFi is just a bank and they have an application. But this couldn't be further from the truth, and we'll look at why SoFi is not just a bank in a few slides. But before we do that, let's quickly talk about the member growth. So since 2021, in 2021, they had 3.4 million members, and now they have 11.7 million members. So they've basically tripled their member count over the last 4 years. And in the most recent quarter, Q2 of 2025, they grew active members by 34%. So SoFi is seeing massive growth in member count. Now, this is the most important slide out of the whole SoFi thesis, and it's exactly what makes SoFi not just a bank. So prior to 2021, the way SoFi's business model used to work is super different from how it works now. Because prior to 2021, SoFi's business model essentially worked as a bank's business model works. So let's say you're a SoFi customer and you go to SoFi to take out a loan, let's say a $10,000 loan. So what SoFi does is they hold that loan on their own books. So if you were to default on that loan for whatever reason, SoFi would get screwed because again, they're holding that loan on their own books. But ever since 2021, they've been rapidly transitioning to a fee-based revenue mix. So, and right now, 44% of the loans that they give out, they don't hold on their own books. Instead, they partner up with a third-party financial institution like Blue Owl Capital, for example. And instead of holding the loans on their own books, they just give it to Blue Owl Capital. And so Blue Owl Capital carries the entire risk. And what SoFi does is they basically collect fees. So right now, they're acting as a middleman, connecting the customer to the financial institution, and all they do is collect fees. And so number one, this massively decreases the risk because once again, they're not holding the loan on their own books anymore. And number two, it massively increases their margins. And so this is a game changer for a company like SoFi. And we can see that in Q2 of 2025, they grew fee-based revenue by 72%. So we can see that the management team is laser focused on transitioning SoFi's business model to a fee-based revenue model instead of just a regular bank. And so although at this point, 56% of the loans they sell, they do hold on their own books, SoFi has an exceptionally high quality customer base. And as we can see here, the average income of a SoFi user that has a personal loan is $161,000 per year. And the average income for a SoFi user with a student loan has an income of $136,000, which is far, far above the average income for the average American. So this goes to show that even the loans that they do hold on their own books, SoFi has an exceptionally high quality customer base. Now for the next part of the thesis, we're going to talk about the valuation model. But before we do that, I quickly want to show you the earnings surprise summary of the last 2 years of SoFi. So over the last 2 years, which is essentially 8 quarters, SoFi has beat on analyst estimates 7 out of 8 times on EPS, and they beat 8 out of 8 times on revenue. So this basically goes to show that SoFi has a very good history of not surprising analysts to the downside. And in fact, they typically beat. And they even beat on their own guidance. And the reason why I'm showing you this is that for the valuation model, we're going to be using management's own guidance. And so this came out straight from the CEO's mouth just 1 quarter ago. And this is exactly what he said. He said the fintech company anticipates 20 to 25% EPS growth beyond 2026. And SoFi expects EPS to range from 55 cents to 80 cents per share in 2026. So essentially, in 2026, they're expecting 55 to 80 cents per share in EPS. And beyond 2026, they're expecting 20 to 25% EPS growth per year. And so we're going to use these values for our model. And we're going to have one aggressive valuation model, and we're going to have one conservative valuation model. And for my aggressive one, we'll start off with 80 cents per share in EPS. So this would be the higher end of the CEO's estimates. So 80 cents per share in 2026. And then we'll assume 25% growth in 2027, 25% growth in 2028. And then we'll assume that the growth will slow down to 20% in 2029 and 20% in 2030. So this is very much in line with the higher end of the CEO's estimates. So 20 to 25% EPS growth, and then 80 cents per share in 2026. And using these values with an exit multiple of 30 times PE, which would essentially represent a price to earnings growth ratio of 1.5, which I think is super fair for a company like SoFi. And we can expect the company to return 16.65% returns per year from now all the way until 2030, which is part of the reason why I think SoFi is a great company to buy today. Now, this is my aggressive assumptions. And if we're going to use my more conservative assumptions, we're going to use, instead of 80 cents per share, we're going to use 70 cents per share. And instead of 25% growth in 2026 and 2027, we're going to use 20% growth from now all the way until 2030. So using these very conservative assumptions, in my opinion, I think these are very conservative, and I think SoFi will blow these numbers out of the park. But even using these super conservative assumptions, we can expect 11.6% returns per year from now until 2030. And 11.6% for me is not enough. So if you want at least 15% returns per year, which is what I aim for my high growth tech stocks like SoFi, for example, I'm looking to buy more of SoFi at $21.6 a share. So even though SoFi right now is one of my largest positions, I think it's my third or fourth largest position in my portfolio, I think I'm looking to add more as SoFi if it drops to $21.60. And the next stock on this list is actually a real estate company, and it's more specifically a real estate investment trust. And before I show you what stock this is, let's first talk about why I think lower rates are very good for REITs. The first reason is that REITs carry tons of debt. And so when rates drop, these companies are able to refinance their debt at much lower rates, which for obvious reasons is good for companies with lots of debts. And the second reason, which I think is the more important reason, is that income investors start moving away from bonds and into dividend stocks. So income investors and hedge funds that invest for income, they start moving away from bonds. Why? Because rates start to drop. And when rates start to drop, bond yields also start to drop. So instead of holding bonds, they start holding dividend stocks, which is exactly why I think massive capital will start flowing from bonds to dividend stocks, which is exactly why I think Avalon Bay Communities is a stock you need to have on your watch list. And the company is diversified all across the United States, with 47% of their properties coming from the East Coast areas like Boston, New York, New Jersey, 40% coming from the West Coast, so areas like Seattle and California. And more recently, they've been expanding to super high growth areas like Florida and Texas, which is something you want to see from a REIT. And nowadays, for most people, renting has been far more affordable than buying a home, which is exactly why Avalon Bay has been able to raise rents substantially over the last few quarters. So in 2022 and 2023, rents have kind of stabilized and not really grown, but in 2024 and 2025, rents have been exploding. And in Q1 of 2025, Avalon Bay has been able to increase their rents by 1.7%, and in Q2 of 2025, they've been able to increase their rents by 2.3%. And because these are residential properties and not commercial properties, Avalon Bay can increase their rents every single year. And now let's move on to the valuation model. Now for REITs, we don't really use things like price to earnings or price to free cash flow or price to sales. What we use is price to funds from operations. And for Avalon Bay, analysts are expecting around 7% growth in 2026, 2027, and 2028 in funds from operation. So if we take 7% growth and we add 3.5% dividend yield per year, that's a 10.5% return per year. So in my opinion, this is the most guaranteed 10.5% returns you can get out of the markets, because this dividend yield is super safe, and 7% growth, in my opinion, is actually super conservative, because historically they've been able to do far more than 7% growth in funds from operations. But if you add to that, the company is now trading at record low valuations of 16 times price to funds from operations. And historically, the average has been around 20 times. And even in the high season, like in 2020 and in 2023, the company was trading at 26 times price to funds from operations. So we have two scenarios here. The very conservative scenario is that the multiple will not expand at all, so we'll continue trading at 16 times price to funds from operations. So in this case, we can expect 7% growth plus 3.5% dividend, so a 10.5% returns per year. This is assuming the multiple does not expand. Now in scenario 2, which I think is the more likely scenario, why? Because interest rates are dropping, so these companies will get a massive re-rating. These REITs and these companies with a massive debt load, these real estate companies, will get massively re-rated over the next 2-3 years, again, because rates are expected to drop massively. So if we take this second case scenario and we take the 10.5% growth plus the multiple expansion from 16 times to 20 times, which again is the average, right? It's not, I'm not taking the high end because that would be way too aggressive. I'm just taking the average over the last 10 years. And so if we take the average and we assume that the multiple expands from 16.5 times to 20 times, we can expect 17 to 18% returns per year from now all the way until 2030. And so I do think this rate cutting campaign will massively shift the flow of capital. And because of that, these are the top 2 stocks that I think are buys in 2025. So I hope you enjoyed this video. Please make sure to leave a like if you find value and make sure to subscribe. Peace.